Market makers will buy from the traders to create their positions, with the heaviest volume being seen at level 3. At level 3, they're all in. They got to reverse and collect their equity back. Understand? When the signal appears, simply buy or sell third level rises and third level corrections against the retail traders. Lights out. If you can count to 3, profit will be realized in these trades. It's a joke oversimplification. Okay? Is there sound issues? No? Okay, cool. Okay, now, this is going to piss you off. It should. In addition to each of the 3 levels, there is a corresponding level of consolidation. Level 1 consolidation. Level 2 consolidation. Most of the time, when this is going on, the stops are triggered in both directions before the next level is started. The zones create 20 to 30 pip swings, be visible on the chart. Market makers are trying to hit the stops both ways to make easy work of the next level. They're trying to take the buying or selling pressure off from the market. So they slap it both ways. That is where, if you guys ever seen those little, they call them pennants. I hate that terminology because I don't like any of that stuff. It's garbage. But look, you have the move, right? They go down, they consolidate. Then what happens is it creates like a little wedge right in there, right? Then they break for the next level. Then they go like this. Forms another wedge. Right? Then they do it again. Now you're going to notice the pins start to the downside. Then they'll reverse. 1, 2, 3. Sorry about your luck. Okay, let me clean the chart back up. Okay. So now write this down and think for a minute. Market maker jumps in, 3:30, 4 o'clock in the morning, 3:30, 3:45 ideal, right? He jumps in. He creates the move, starts to panic. He shows you breakout vector candles the wrong way. He's showing you something, get the retail guys to bite. Retail guys bite the wrong way, he's got them. He pulls back quickly off of the high. He goes at it again one more time to validate, hit the stops. He then shifts away from that, 25 to 50 pips in the first level and goes into consolidation. He then swings both ways. He may come back towards the high of the day. That move, coming out of level 1 consolidation back towards the high or back towards the low, scares you out of a good trade. Scaring you out of a good trade is his job to make sure you don't actually make any money when you're right. Each zone of consolidation creates a little tiny wedge, if you will, on the chart. The pins are issued in both directions, and then the next level drop or rise is seen. He stands aside during that cycle, cycle 2, level 2 forming, sees how the orders are set, and then he says, okay, that's enough, and he reels it back in. He then switches the pins against the move. So if the cycle is down, the pins will start going to the downside at level 3. You'll see the spike candles, more aggressive moves will be seen towards the downside. If price is rising and level 3 is shown, the spikes will turn to the top side. Why? He's trying to trap the traders before he reverses. Okay? Think. All right, let's have a look. Get my little pen. This is classified, by the way. I could show it to you, but then I have to kill you at the end of the seminar. All right, look. 3 hits to the high. Didn't just this exactly just happened. This slide's like 2 years old, man. Remember I told you we pulled the curtain out from behind Oz. It's the same shit every single day, day in and day out. 3 hits to the high, stop hunt at London Open, hammer at 345 and 945. That's all they got. It's the same move over and over. Once you can identify it, you own them. Okay? So now, market maker starts the stop hunt, creates the panic. You reevaluate your consolidation zone. He goes vector to the high on you. He doesn't take out the previous high. Second leg M. Bam. Peak formation is formed. You enter somewhere in here. You got about an hour to decide. Level 1 correction. Pins down. Pins up. I see what you mean about the color. Let me change it. Let me find something pretty like a yellow. Okay. Wow, it erased it. Sorry. I don't know if that's any better. Correction, right? We enter in here. Pins up, pins down, forms kind of a little pullback wedge, right? Level 2 of the correction is smaller and weaker. But again, market makers hit the pins on both sides before the next level is commenced. Now something kind of funny happens. He goes into level 3 correction. He's got vector to the low in here. 3 pushes down to finish out the level, right? Funny how I only see pins on the bottom now. Here, and here, and here. Those candles were all the way down at one time. He's working the low. Now we know we've had on average a 50 pip drop per level. So we're at ADR, 150 pips. At 150 pips ADR, he starts issuing a pin at the bottom of the candle. The pin is a wick on the candle, whoever's asking. He starts issuing pins at the bottom. Do you notice that there's no pins on the top of these candles? Not necessary. I'm trying to trap short holders. So I push the market down, bam, snatch it away, gotcha. I hang around for 45 minutes, push the market down, bam, gotcha. Hang around for an hour, push the market down, bam, gotcha. The third confirmation doesn't happen very often, but I like this chart because there was 3 confirmations here, and then 3 mini confirmations. I can't draw it down there. It'll change the slide. Sorry. And 3 mini confirmations. 1, 2, 3. Do you see how 3 plays into the psychology almost always on these charts? 3 hits to the high, 3 levels of drop, vector 3. 3 pushes to the low, 3 pushes to the high, 3 pins to the low. In the retail world, that gets you to chase the wrong setups. In our world, it gets you to identify his behavior and beat him. Understand that this happens all the time in the market, in every market. You just have to identify it in real time, and the journey starts tonight. Okay, pretty cool stuff. I'm a little excited. I don't know. I really like this stuff. Okay, I can't change the slide. It jammed. There we go. All right, now, here you are again. Variation on the theme. Time. Consolidation. 1, 2, 3 to the high to end the session. Vector. Happen to have a little news in here. Market makers hit the stops in both directions with a spike. That trade's still good. How do I know? The high was not taken out. The high happened to hold. You have your peak formation high. You have your high of the day, U.S. session, and you also have your peak formation high of the week. What do I expect tomorrow? I expect stop hunt, rise, drop. Why? Because I got the cycle now. I nailed it. It's anchored. Okay? Notice something kind of crazy in here too. There's 3 vectors in here on the downside. And then notice something else in here? There's 3 little baby vectors in there. And then they come back in the second leg. Form the W out and reverse. This is not a very good counter, remember? Okay, consolidation. Stop hunt high. This one happens to be, I'm going to write this initials down. You're going to say, what the hell? That's a stop hunt high, hold the mayo. It's not a sandwich. It's a trade. Stop hunt high, hold the mayo is simply market makers came out of the box, out of the consolidation. They used the 200 moving average as the trigger, which offered resistance at the perfect timing at the stop hunt. You know that this trade is a drop. How do you know? Because you already got your high of the week, high of the day, peak formation. Stop hunt high, hold the mayo. The stop hunt trigger bars are held in place by the mayonnaise. This is also 2 pins to the mayonnaise. Okay? You have your drop. This is an example of where you have one level of move, and then you have 2 and 3 the next day. Then what do you have? Just outside the red box, they issue a hammer to trigger the stops of the continued, or the people that got it right long. Second leg, right? They come in, session changeover. They need to hit it one more time to get the stops. That's your entry. Back into consolidation, end the day. They end the day always how they start the day. Okay? Away from the traders that are jammed up down here, they want to stick them. Okay? Okay, good stuff. All right. The peak formation started the end of the week on Friday in this example. Stop hunt high, sell. They push down. See the low? That blue tracer lets me know that yesterday the price came in like this. When they go back to that, I got it. Second leg, same level, failed to break. Second leg, same level, failed to break. That's a big, fat W staring at you. That's good for about, I don't know, 400 or 500 pips, 300 pips. The retracement's 140. That's a 300 pip move. Continuation from Friday. Notice how they caught the retailers with the gap right there. We don't fall for that crap. We don't care. We got peak formation low. PFL. Peak formation low. That looks like an E, sorry. Here, let me see if I can do that. Peak formation low. Sunday going into Monday. There's your gap. Readjust your consolidation for the breakout guys. Readjust your market maker spread. There's your initial HOD. Initial low in here. Readjust. Because they gapped and shifted away. They gapped and shifted away. They don't want anybody to have a profit. They got them stuck. Now they come back. London Open. W formation. Second leg happens to be railroad track. Straight rise. Do not hold over the weekend. I'm not telling you to hold over the weekend. I'm showing you how to analyze the chart going into Monday. I see peak formation Friday. I know where I'm at. Now coming out, I expect straightaway. Why straightaway? They have to aggressively get the hell out of here because they jammed all these traders. Right? They got to get the hell out of that range because they want to stop everybody out and get them into margin trouble because they know who's in trouble. They have their list from the plugins. They got $100 million in margin trouble. If I clean that out, I'll put that in my pocket. I'm a market maker. So that's where the aggressive break trade comes. This also, by the way, happens to be the day that breakout traders make money. Second day of the cycle. Okay? In consolidation, what do you expect one more night? Okay, what's the cycle? W, V1, V2, M. That's the cycle, right? Anchor point, peak formation low. Day 2, day 3, reverse. Here you go. Day 1 rise. Consolidate, back into consolidation. Stop hunt low, rise. All of a sudden, the pins turn to the top side. Three levels of rise built into there. They come back just outside the U.S. Open. Issue railroad tracks. Retrace 140 pips, in case you were bored. They don't have unlimited equity. They must grab it back at some point in the cycle. Now, we'll talk about the continuation, but they can make a W and continue on the uptrend over here. They book a profit, get back into direction. Why? They have longer-term goals that they have to be cognizant of. If you think about this, if they went 3 days up, 3 days down, the market would never go anywhere. It would sit there sideways, right? And surely you'd figure it out. I know Craig would, because he almost figured this out. Now, if you notice that trade, 150 pip retracement, 2 pins to the mayonnaise. If they put the second leg in at the mayonnaise, there's your stop hunt low, hold the mayo at the U.S. session in the red box. There's your retracement trade. These things repeat over and over and over again, and you're going to see them in the charts. And once you see them, you can't unsee them. They're in there.